$5 billion vanished in a matter of hours. Not over months, not over weeks. In roughly 48 hours, positions that looked untouchable were forced into the market at any price, and the chart that had been telling people new highs are normal now suddenly looked like a trap door. And here's the part that breaks normal expectations. This came right on the heels of Bitcoin briefly, tagging about $93,000 in early January 2026, the kind of level that makes the average headline sound like the future has already arrived. The story was simple. Institutions are here, the uptrend is mature, the market has grown up. They said this kind of liquidation event couldn't happen anymore. Not at this scale. But the market doesn't care about the story. It cares about positioning. Because while most people were watching the price, the real signal was in the pressure building behind it. The leverage that didn't show up in the glossy charts. The flow that looked supportive one day and suddenly reversed the next. The gap between what the market was saying out loud and what it was whispering through its plumbing. Institutions already know how to read that plumbing. Most people don't. That's not an insult. It's just how markets work. The professionals study the pipes. Everyone else watches the water. So let me show you what the data actually says. Not opinion, not vibes, pattern. Because what I'm about to reveal changes how this entire move makes sense. It only looks irrational until you see the trap. Welcome to Vaultline. This is where we decode what matters before it becomes headlines. Tracking flows, incentives, and pressure points most people miss. If you like calm data-first analysis, you'll fit right in. And if you're watching from somewhere unexpected, drop a comment with where you're tuning in from. It helps map how this story travels. Now, here's what actually happened in forensic detail. On January 5th, 2026, Bitcoin briefly traded around $93,000. That alone isn't the story. The story is what happened next, because the market didn't simply cool off, it snapped. $5 billion in forced liquidations hit the crypto complex around January 30th to 31 as volatility returned with a vengeance. When the market is healthy, pullbacks happen with friction. People sell, other people buy, and the move has texture. When the market is unhealthy, pullbacks happen like a vacuum. The bids disappear, stops trigger, liquidation engines fire, and the selling becomes mechanical, not emotional. That's why this matters. Because mechanical selling isn't a judgment on the asset, it's a judgment on the positioning. At the same time, the public conversation was dominated by a different signal. Spot Bitcoin ETF flows. Early in the year, the tape printed big numbers, 1 billion. If you only watch that, you assume the path is straight. Big inflows equal big conviction. Big conviction equals big stability. Then the narrative flipped. In the first full trading week of 2026, spot Bitcoin ETFs reportedly saw about $681 million in net outflows, with 4 straight sessions of money leaving. So, which is it? Institutions are buying, or institutions are leaving? That contradiction is the central mystery, and it's exactly how traps form. To see the trap, you have to slow the tape down to the daily level, because the sequence matters. It started with very specific prints. 2 million. Those are not small numbers. In traditional markets, a few hundred million can move a niche product. In a market built on narratives, it can move psychology. But then the very next stretch of sessions flipped hard enough to erase that optimism. 378 billion. That's the key detail. This wasn't a slow fade. It was money coming in through the front door and leaving through the side exit almost immediately. And when you look under that weekly number, you see something even more revealing. 9 million. Again, don't fixate on any single day. Fixate on the pattern. Large flows, back to back, in the opposite direction. This is the part no one likes to admit out loud. Those flows can represent investors changing their mind. They can also represent positioning being unwound. Because ETF flow is not a pure vote. It's an accounting of share creation and redemption. When demand is strong, authorized participants can create new shares. When demand weakens, they redeem. But authorized participants are not doing this for moral reasons. They're doing it because a spread exists, because hedges exist, because inventory management exists. So the same product that looks like a one-way pipeline for institutional adoption can also become a two-way valve for fast money. In calm periods, that valve adds liquidity. In stress, it can accelerate the unwind because it gives large players a clean on-ramp and off-ramp. If you've ever wondered why price can fall even when big money supposedly arrived, this is one answer. It's not that the big money lied, it's that big money trades. It scales in and out, it hedges, it rotates, and it does not confuse access with loyalty. Now add one more layer. Some of the largest outflows can cluster in a single product. 32 million in net redemptions over that early 2026 outflow stretch. Whether it's one issuer or several, the point is the same. The regulated channel can concentrate the flow just as much as the offshore channel can concentrate the leverage. When you combine concentrated flows with concentrated leverage, the market becomes a spring, You can compress that spring for a long time. It looks stable. It looks controlled. Then one sharp move releases it, and the release looks irrational only to the people who forgot the spring was there. To understand it, you have to zoom out, not just to last month, to the playbook the market has run for decades. In 2013, Bitcoin ran hard, euphoric and vertical. The structure was simple: thin liquidity, huge momentum, and then a sudden air pocket where forced sellers discovered there weren't enough natural buyers at the same levels. The result wasn't just a dip, it was a regime change. In 2017, it happened again. Price accelerated, narratives got cleaner, and the crowd mistook participation for permanence. It was the end of a specific positioning structure. Leverage, speculative excess, and fragile liquidity met a catalyst, and the market did what markets always do. It punished the crowded trade. In 2021, the pattern showed up in a more mature form. This time, it wasn't just retail. It was sophisticated players using derivatives, borrow and structured exposure. The result was the same, just faster. When the pressure released, it released through liquidations. Now, in 2026, the cycle isn't identical, but the mechanism rhymes. The rally that looks clean on the surface can still be built on a brittle base. And the more confident the crowd becomes that this time is different, the more valuable it is to ask one question: different in what way? Because the identical playbook across decades isn't about the asset. It's about human incentives inside a market. And if you think this leverage and margin story is unique to crypto, it isn't. Markets have run this film before. 6 billion private rescue to avoid a disorderly fire sale. Different assets, same mechanism, leverage meets stress, and liquidity vanishes at the worst moment. In 2011, during a famous precious metal surge, margin requirements on a major futures contract were raised 5 times in 9 days. You can argue about narratives all day, but the mechanical outcome was the same. Tighter margin forced weaker positions to shrink, and the price action snapped. The asset changes, the psychology changes, the math does not. Here's the pattern stripped down. First, there's a catalyst that feels like legitimacy, a narrative that makes participation feel safe. That can be a new access route, a regulatory shift, a new class of buyers, or simply a breakout that lasts long enough to feel permanent. Second, money piles in. Not just spot money, levered money, money that wants exposure without patience. Third, volatility compresses. The market looks calm, so people take more risk. Then a small move triggers a bigger move because risk was concentrated, not diversified. Fourth, the unwind. Forced selling creates its own momentum, and the crowd calls it irrational because they were looking at the narrative, not the structure. In 2013, the result was a brutal drawdown after a parabolic run. In 2017, the same. In 2021, the market delivered multiple liquidation cascades and sharp regime shifts. In 2026, we saw the beginnings of that familiar release valve, a violent liquidation event after a confidence peak. So who are the players, and what were they doing while this played out? Start with the spot ETF ecosystem. ETFs are a bridge between traditional capital and a volatile asset. But a bridge doesn't change the river. It changes who can cross and how quickly. When you see a huge inflow number, it can mean long-term allocation. It can also mean short-term positioning. Institutions don't all behave the same way. Some buy and hold, some arbitrage, some hedge. Some are market makers whose job is to provide liquidity, not express conviction. And incentives can flip overnight. Now look at the derivatives complex, especially the big regulated venue that traditional players use, CME. One reported data point showed CME Bitcoin futures open interest at 23,462 on the January 30th, 2026 trade date. Open interest isn't a directional bet by itself. It's a measure of how much exposure is sitting on the table waiting to be tested. High open interest can coexist with calm prices for a long time. It's like stacking dry wood. Nothing happens until a spark hits. And when it does, the fire spreads fast. Then there are the exchanges, the leverage platforms, the perpetual futures markets, and the liquidation engines that sit behind them. These systems don't care about belief. They care about margin. Margin is the invisible hand most people ignore. When margin requirements are easy, positions expand. When volatility rises, margin pressure tightens. When margin pressure tightens, weak hands are forced out. And forced selling isn't a choice, it's an instruction. Now add in something else most people miss: timing coordination that doesn't require conspiracy. It requires only shared incentives. Market makers hedge. Arbitrage desks rotate. Funds de-risk into volatility. Risk managers cut exposure when correlations spike. And because many institutions use similar models, the timing can look coordinated even when it's simply systemic. That's why the move looked like it made no sense. The crowd saw a story of adoption and stability. The plumbing was telling a story of crowded leverage and fragile liquidity. And this is where the dislocation appears. On the other side, you had stress signals. Massive liquidation waves, volatility returning, and a sharp drawdown that suggested the market wasn't absorbing risk smoothly. two data streams, opposite signals, same week. That's not random. It's a dislocation. In a healthy regime, inflows and stability tend to align. In a stressed regime, flows can be misleading because the market isn't one thing. It's multiple layers. Spot buyers can be buying while leveraged longs are being liquidated. ETF inflows can be strong while offshore perpetual markets are overextended. A big buyer can enter while a bigger forced seller is exiting. And the price will reflect the net of those forces, not the headlines. So let's put numbers on the gap. $1 billion in ETF net inflows across two early sessions, but later see about $681 million in net outflows across a single week. That's not a gentle shift. That's a reversal in the public-facing channel of demand. At the same time, when liquidations print in the billions, that's a different kind of flow, forced flow. It's demand destruction and supply creation at the exact worst moment. This is the part no one is discussing. Forced selling can overpower bullish narratives even if the bullish narratives are true. A market can be structurally bullish and still crash in the short run if the positioning is brittle. And brittle positioning is exactly what leverage creates. Here's an analogy that makes it simple without dumbing it down. Imagine a crowded theater with a wide exit. People can leave calmly if they choose. That's a normal market. Now imagine the same theater with the same wide exit, but someone yells, "Fire," and the crowd surges. The exit didn't shrink, but the flow changed from voluntary to forced. People trip. The speed of movement becomes the problem. Leverage turns a market into that theater. It's not that buyers disappear forever, it's that the liquidation cascade changes the speed at which positions must exit. And when the speed overwhelms liquidity, price falls until the flow can clear. That's the mechanism. First, leverage builds because the trend looks stable. Funding costs look manageable. Volatility looks quiet. Traders increase size. Second, a trigger hits. It can be a macro headline. It can be a risk-off day. It can be a sudden move in rates or the dollar. It can be nothing more than a large seller. Third, price dips enough to stress the most levered positions. Liquidations begin. Liquidations push price lower. Lower price triggers more liquidations. It's a loop. Fourth, the loop ends only when enough positions are cleared and enough natural buyers step in, or when the price moves far enough to attract deep liquidity. That's why the move can feel like it makes no sense. It's someone being forced. Now bring the institutional layer back in. Institutions that participate through ETFs often also hedge through futures. Market makers who create ETF shares and keep the product aligned often use futures to manage risk. Arbitrage desks might buy spot exposure while shorting futures, or vice versa, depending on spreads. So the same day you see ETF inflows, you can also see hedging that caps upside. The market can feel heavy even as the public flow appears bullish. Then when volatility spikes, the hedges change, spreads widen, and the entire structure shifts. This is where it gets interesting. The institutional inflow story can be true and still set a trap for late momentum. Because the trap isn't about whether institutions participated. It's about how the market interpreted that participation. The crowd reads it as a vote of confidence. The professionals read it as a new source of liquidity to trade against, hedge around, and arbitrage. And once the crowd becomes sure, the risk shifts. That's why you see sharp contradictions. A market can be both accumulating and fragile. It can be in a long-term adoption trend and still experience violent short-term flushes. So what does the evidence suggest? The evidence is in the mismatch between calm confidence and stress outputs. Bitcoin briefly reaching about $93,000 in early January 2026 indicates demand was sufficient to push price to a psychologically important level. The reported ETF inflow bursts indicate significant activity through regulated channels. The reported CME open interest figure indicates sizable derivatives exposure sitting in the system. 5 billion shows the leverage embedded in the structure was large enough to unwind violently. That combination isn't random. It's a classic setup. Legitimacy narrative plus rising exposure plus compressed volatility, followed by a shock that forces positioning to reset. Historically, it means something more precise. When a market clears leverage through forced selling, it often creates one of two outcomes. Outcome one, the flush resets positioning and the market can rebuild on a cleaner base. Volatility stays elevated, but structure improves because weak positions are gone. Outcome two, the flush is the first crack and deeper de-risking follows, especially if broader risk markets tighten. Liquidity conditions change, or the next leg of selling comes from more patient holders deciding the regime has shifted. Notice what's missing. Certainty, guarantees. The market doesn't owe anyone a script, but it does have tendencies, and the tendencies show up in repeatable indicators. So if you're watching this like a strategist instead of a spectator, what would you watch? 1, watch whether ETF flows stabilize after sharp outflows. A reversal from outflows back into steady inflows can signal that the regulated channel has absorbed the shock. Continued outflows can signal that the bridge is being used as an exit route, not an entry route. 2. Watch futures basis and open interest behavior. If open interest collapses with price, it suggests leverage is being cleared. If open interest stays high while price weakens, it can signal positions are still crowded and the risk of another cascade remains. 3. Watch volatility, not just price. Volatility is the tax on leverage. When volatility rises, margin pressure increases and weak structures break. Now let's map 3 scenarios, not as predictions, but as historically consistent paths. In a conservative scenario, the market chops. After a liquidation event, price stabilizes, oscillates, and rebuilds. Volatility remains higher than the complacent period, but the structure slowly improves. The story becomes boring again, which is exactly what healthier markets often require. In a moderate scenario, the market retests lower levels. This doesn't mean collapse. It means the liquidation was a first clearing, and the system needs a second round of de-risking before stability returns. Historically, these retests can happen as participants regain confidence too early, relever, and then get punished again. In an aggressive scenario, broader liquidity conditions tighten at the same time, and risk assets across the board de-risk. In that environment, crypto can experience outsized moves because it carries higher volatility and is often treated as a risk-on asset in stress periods. Historically, that combination can produce deeper drawdowns, followed by powerful recoveries, but only after the pressure is fully released. Again, none of this is a promise. It's a map of tendencies. So why call this a trap? Because the trap wasn't the rally itself. The trap was the interpretation. The move made no sense to people who assumed institutional participation equals stability. But the market's plumbing shows that institutional participation can also increase complexity, accelerate moves, and amplify the speed of reversals. ETFs make access easier. Easier access can mean more demand. It can also mean faster exits. Futures deepen liquidity. Deeper liquidity can mean smoother trading. It can also mean larger leverage stacks. The same infrastructure that supports the market can, under stress, make the unwind faster. That's the paradox. And that's why those who understand this aren't necessarily smarter. They're just paying attention to different signals. Most people watch price and narratives. The professionals watch flows, leverage, and liquidity. That information gap becomes a wealth gap over time, not because anyone is evil, but because markets reward those who understand structure. Institutions move first, as they almost always do, because their job is to manage risk. Retail tends to move last, because retail is sold the story after the positioning has already been built. So the choice ahead is simple. You can watch the headline levels and feel whiplash when they break, or you can watch the pressure building behind the levels and recognize that the violent move was a release, not a mystery. The market didn't betray anyone. It did what it always does when leverage becomes the invisible foundation of a safe story. And once you see that, this move makes perfect sense. This is Vault Line, where we decode what matters before its headlines. If this connected dots you hadn't seen before, you know what to do. And the question isn't whether markets will keep springing traps. The question is whether you'll recognize them before the door closes.